Trump signed a tax law in July 2025 that could save business owners over $100,000 in 2026. But here's the catch. Most CPAs are still using last year's playbook. And if you don't know what changed, you're leaving serious money on the table. I'm Henok, but I'm a licensed certified public accountant and founder of HK Financial Advisory. For over a decade, I've helped business owners and high-income earners save 5 and 6 figures using advanced tax strategies most professionals never touch. And today, we're breaking down the new tax law. This is the One Big Beautiful Bill Act, or otherwise known as OBBBA. It was signed into law on July 4th, 2025, and it just rewrote the tax code for business owners, real estate investors, and anyone making serious money. I'm going to walk you through the 5 biggest changes and one bonus strategy almost nobody's talking about. By the end of this video, you'll know exactly where the money is hiding. So stay with me. Number 1 alone could save you $50,000 or more. So let's get into it. Number 1, and this is the big one. One Big Beautiful Bill Act brought back 100% bonus depreciation permanently. Now, if that sounds technical, let me put it in plain English. Before this law, when you bought a vehicle, equipment, or qualifying property for your business, you could only write off a portion of it in that year. In 2025, that was just 40%. Now, it's 100% full deduction in year 1 alone. So here's a real example. Let's say you buy a heavy SUV for your business in 2026. Let's say it's $80,000 truck. Under the old rules, you would deduct around $32,000 in year 1 and stretch the rest over 6 years. Under One Big Beautiful Bill Act, though, you write off the entire $80,000 immediately. That's a deduction that could save you $25,000 to $30,000 in real tax in 1 year. Now, here's where most people mess this up. The property must be placed in service and acquired after January 19th of 2025. All right. So if you signed a binding contract before that date, you might be stuck under the old phase down. This is where timing matters. And the IRS just issued Notice 2026-11 in January, confirming the rules. This is the strategy we implement for clients planning major equipment, real estate, cost segregation, and vehicle purchases. If you're sitting on capital and waiting, 2026 is the year to deploy it. Number 2, the QBI deduction. So if you're an LLC owner, S-corp, partnership, or sole proprietorship, this one is for you. The 20% qualified business income deduction, also known as Section 199A, was set to expire at the end of 2025. But One Big Beautiful Bill Act made it permanent. So that means if you're an LLC owner pulling in $300,000 in profit, you keep deducting 20% of that income, $60,000 deduction, year after year. No expiration, no more uncertainty. Now here's the upgrade most CPAs are not talking about. Starting in 2026, the phase-in range is expanded by 50%. So for single filers, it goes from $50,000 to $75,000. For married filing joint, it goes from $100,000 to $150,000. So what does that mean for you? That means more room to qualify if your income is climbing. Less rush to manipulate it down. There's also a brand new deduction, $400 guaranteed if you have at least $1,000 in qualified business income and you materially participate. Most people don't realize this expansion happened. It's one of the strategies we use to restructure compensation for our high-income clients. Number 3, the SALT cap. If you live in a high-tax state like California, New Jersey, New York, DC, Maryland, listen up closely. The SALT tax deduction lets you write off state and local taxes on your federal tax return. For years, that cap was stuck at $10,000. But under the One Big Beautiful Bill Act, that just raised it to $40,000. So that's 4 times the deduction. Here's where people mess this up though. There's a phase out that kicks in at $500,000 of your modified AGI for married couples and starts dropping the deduction back toward the old $10,000 floor. So if you're a high earner pulling in $700,000 or more, the math gets tricky really fast. But for the business owner making $300,000 to $500,000 in a high tax state, that's potentially a $30,000 additional deduction. And it pairs perfectly with a pass-through entity tax election in your state. So that's a layered tax strategy. We help clients run that math every year. The $40,000 cap, though, it runs only up to 2029. So this is not forever. If you've been itemizing or should be, rerun your numbers. Number 4, and this one is a refund opportunity most business owners don't even know they have. If your business does any kind of research and development, so like software, product development, engineering, even certain creative work, pay attention. Under the 2017 tax law, R&D expense had to be capitalized and amortized over 5 years. That was brutal for small businesses. One Big Beautiful Bill Act, though, killed that rule. So starting in 2025, domestic R&D is fully deductible the year you spend it. But here's the part nobody's talking about. If your business averaged 31 million or less in gross receipts, you can actually amend your 2022, 23, and 24 tax returns and claim the deduction you missed. That's a retroactive refund. So for SaaS companies, software developers, or service businesses that have been quietly capitalizing R&D for 3 years, we're talking thousands, sometimes tens of thousands in refund checks. This is one of the strategies we run for clients during onboarding. The window is open. The IRS expects amended returns. See, most CPAs aren't proactively filing them. Number 5. So this is for my high net worth families watching. The estate and gift tax exemption was scheduled to cut in half in 2026. That's been hanging over wealthy families for years. But the One Big Beautiful Bill Act killed that sunset. So the exemption is now permanently set at $15 million per person, $30 million per married couple, which is also indexed for inflation starting in 2026. So what does this mean in plain English? If you and your spouse have a combined estate of up to $30 million, your heirs pay 0 federal estate tax. Above that, you'd be looking at 40% tax on every dollar. Now, here's where most people mess this up. A lot of families were panic gifting in 2025 to lock in the exemption before it dropped. You don't need to do it anymore. But that doesn't mean you skip estate planning. It means the strategy changes. So from urgency-based gifting to long-term legacy structuring. This is exactly the kind of planning we walk our clients through. And here's one quick bonus most people haven't even heard about yet. One Big Beautiful Bill Act created something called a Trump account, a new tax-advantaged investment account for children. Here's the part business owners need to know. So starting in 2026, employers can actually contribute up to $2,500 per year to an employee's child's Trump account. And it doesn't count as taxable income to the employee. So if you've got a business with employees, this is a powerful benefit you can offer. If you're an S-corp owner with kids, talk to your CPA about the strategic angle here. The regulations are still developing, but the door is open. So look, here's the truth about taxes. The IRS doesn't reward you for filing on time. They reward you for planning before December 31st. If you wait until April, it's too late. These One Big Beautiful Bill Act strategies, the bonus depreciation, the QBI, the SALT, the R&D refund, they require active decisions, documentation, and structure before the year is done. At HK Financial Advisory, this is exactly what we do. We help business owners and high-income earners build a custom tax plan around the new tax law. And most of our clients save 5 to 7 figures legally. If you want to know how much One Big Beautiful Bill Act could save you in 2026, book a free strategy session. The link is in the description and pinned in the comments. Do not leave money on the table. I'm Henok. I'm a licensed certified public accountant, and I'll see you in the next one.